The risk of not investing or being too conservative. The one thing I can guarantee will not work well as an investment is cash. Warren Buffett. Most investors understand that they need to invest to maintain purchasing power and stay ahead of inflation. They also understand the basic concept of risk versus reward. But when it comes to real-life decision-making, especially for retirees, the biggest concerns are clear: loss of principal and market volatility. Whether you are 25 or 85, the reality is the same. Everyone wants to make money, and nobody wants to lose it. So the real question becomes, how much volatility can you tolerate, and what level of drawdown are you willing to accept during difficult market cycles? When investors become more risk-averse, they often gravitate toward cash. On the surface, it feels safe. It doesn't fluctuate. The balance doesn't go down. But here's the truth. Cash is not risk-free. It simply carries a different type of risk. Cash is a guaranteed loser to inflation over time. Inflation represents the rising cost of goods and services, driven by an expansion of money and credit relative to supply. In simple terms, it erodes your purchasing power. In recent years, we've seen interest rates rise significantly. Certificates of deposit, CDs, which once paid near zero, have offered yields in the 3% to 4% range, and at times even above 5%. That sounds appealing, but again, it's all relative. During the same period, inflation surged to levels not seen in decades. So even when CDs were yielding 4% or 5%, real returns were often minimal or even negative after inflation. In other words, earning interest doesn't necessarily mean you're getting ahead. This highlights a critical concept that many investors misunderstand. Risk is not eliminated, it is transformed. When you invest in CDs or hold large amounts of cash, you significantly reduce your risk of short-term market loss. But at the same time, you increase your risk of losing purchasing power. Your risk hasn't gone away, it has simply changed form. You can choose your risks, but you cannot avoid them. Another concept that is often overlooked is opportunity cost. Your total risk is not just what you own, it's also what you don't own. Every dollar allocated to cash is a dollar not participating in other potential opportunities, whether that's equities, real assets, or alternative investments. And over time, this unseen cost can be enormous. Psychologically, this is difficult. Humans tend to overvalue what they already have and undervalue what they might gain. Losing money feels far worse than missing an opportunity, even if the missed opportunity is ultimately more costly. That's why some of the biggest losses investors experience are the ones they never see. Opportunity loss often outweighs capital loss over a lifetime. The key takeaway is simple. You must take on some level of risk just to maintain your purchasing power. Beating inflation should be the minimum objective for any long-term investment strategy. And yet, many investors continue to hold excess cash, not because it is optimal, but because it feels secure. Security in a stable account balance, security in liquidity, security in avoiding short-term fluctuations, but that sense of security can come at a long-term cost. To put this into perspective, consider the rule of 72. By dividing 72 by your rate of return, you can estimate how long it takes to double your money. At 9%, your money doubles in approximately 8 years. At 7%, it takes about 10 years. At 3%, it takes roughly 24 years. But here's the catch. If inflation is also running around 3%, then a 3% return isn't growth. It's simply maintaining your purchasing power, which means even if your account balance is growing, your real wealth may not be. Cash absolutely has a role for emergency reserves, short-term needs, and stability. But beyond that, the question becomes, are you preserving your wealth or slowly eroding it? For more information, please contact Scott Brooks at 949-545-6500. The information presented in this video is for informational and educational purposes only and should not be construed as an offer to buy or sell any securities or as a solicitation of any investment strategy. For more information, please contact our office at 949-545-6500